International media and the broader community are unleashing severe criticism against the administration of the US President Donald Trump, accusing him of destabilizing the market through chaotic and irrational economic policies. The imposition of tariffs on the largest US trading partners could have unpredictable consequences, potentially pushing the US into recession. Goldman Sachs analysts upgraded their forecast of a US recession from a 15% to 20%, while JP Morgan has increased this likelihood from a 30% to 40%. At the same time, Morgan Stanley analysts have lowered the US GDP growth forecast to 1.5% for 2025 and just to 1.2% for 2026. Against this backdrop, US Treasury yields have plummeted instantly. The number of Treasury buyers will decline even further. Foreign central banks are not interested in buying the US government debt, while major investment funds are shifting their capital into alternative assets. And this is intensifying pressure on Wall Street, leading to a significant downturn in the stock market. As a result, the S&P 500 has already recorded its worst performance since last December, while the Nasdaq has suffered its biggest plunge since September 2022. The US economy is no longer seen by investors as a stable and reliable asset. The decline in the US stock indexes did not lead to a stronger dollar, not even as a safe haven currency. The threat of a recession serves as poor publicity for the US currency. Besides, expectations for a rate cut by the Federal Reserve have now shifted from July to May. As a result, the six-currency dollar index remained near its 4-month low on a Tuesday, hovering just above the critical 103-point level. However, the slide of the US dollar does not necessarily mean that the euro has strengthened. The threat of trade tariffs is also weighing on the European currencies, and much will depend on Germany's political situation. The reforms proposed by the Chancellor Friedrich Merz require approval by a two-thirds parliamentary majority. Previously, Germany's Green Party had promised to oppose these measures while expressing readiness for negotiations. It now seems that some political agreements have been reached, as a Green Party leader Franziska Brandner made a more optimistic statement in an interview with Bloomberg today. If this agreement truly works, the euro could soar to as high as 1.10. Importantly, the ECB has no intention of proceeding with the rate cuts on an autopilot, and this was stated yesterday by the ECB Governing Council member Joachim Nagel. While the Federal Reserve is forced to adopt a more dovish stance, the Eurozone regulator can afford to stick to its hawkish plans. As a result, the US dollar index has tumbled by 3.6% over 6 sessions, while the euro has strengthened by 4.8% during the same period. Moreover, technical analysis of the daily chart has confirmed the shift in the market sentiment from buyers to sellers. A successful breakout within the ascending channel could strengthen the bullish outlook, pushing the euro-dollar pair up to 1.1050. In the case of a bearish scenario, the key technical support levels are 1.0716 and 1.0517. Oil prices have steadied today, mainly due to broader risk aversion and a focus on safe haven assets. Traders are concerned that the US President Donald Trump's trade policies could slow global economic activity and reduce oil demand. Brent crude is trading today slightly higher in the range of $68.60 to $70.40 per barrel. However, despite moderate gains, the short-term outlook for the oil market remains bearish. For 2 consecutive weeks, the Russian ruble has been showing remarkable resilience against major global currencies. Next week, the ruble may find support from the upcoming tax period and increased foreign currency supply from exporters. However, the primary driver will remain geopolitical developments. As a result, the ruble strengthened to about 85 versus the US dollar today. So that's all for now. We continue to follow developments in the financial markets. Subscribe to our channel and follow news with us. See you.